Hey, it's Mike over at Cross Country Mortgage, and it's Monday morning. It's time for your Monday morning mortgage update for the week of March the 3rd. Hope you all had a good weekend. I always try to give you insight, tools, and tips about what's happening with the mortgage market moving forward, what happened last week, so you can make some great decisions in buying, selling houses as we move through the week. So, wow, it's the first week of March already. A lot of stuff going on this week, but let's talk about what happened last week. We saw a great improvement to mortgage rates. A lot of it had to do with just some weaker numbers and expected numbers that came out with the economy. Let's go right to the mortgage-backed securities charts. You can see the movement. I always like looking at this in visual. So this is a 3-month average of the trading of mortgage-backed securities, 6-month average, and it just shows you each day of trading with this. When we see this graph go down, that means money's flowing out of the bond market and rates are going up. When we see the graph go up, like we did last on the right side here, at the end of last week, that means money's flowing into the bond market. We're seeing better rates. And we've been in such a flat trading channel for most of January and even into half of February with a lot of volatility. But last week, the last week and a half, look at this nice little increase, meaning money's flowing into the bond market. Why is that happening? We're just starting to see some signs that the economy is weakening different places. Last week specifically, we saw consumer sentiment reports came out. This is a report that comes out with a bunch of different data and points every month, and it just showed the consumers basically feeling not so good about the economy. They're spending less money, and when bond traders hear that, they start shifting their money into the safer bond market for kind of a flight to safety. GDP, gross domestic product, is our economy growing at expectations? Now, an interesting report came out over the weekend that showed projected GDP for the next quarter might even be a negative growth. Now, this is just projections, estimates. Everybody's trying to get ahead of the curve, but we really want to pay attention to this. There's been a lot of concern that the numbers have been coming out with GDP have been cooked and haven't been real because they've been in conflict with some other data points that have came out. So we'll be watching our growth. And then PCE, the big thing Friday of last week, inflationary reports came out, and the PCE came out, and this is the main report that the Fed uses for their next meeting coming up, and it was at expectations. So that was actually positive. It didn't go up at expectations, and that's why we saw the bond market actually improve, because we know inflation is the death of mortgage rates. So what are we looking at this week? Geopolitical and jobs, and then the Federal Reserve. So geopolitical, the two things that are on the docket this week is obviously Ukraine and Zelensky and Russia. Boy, what a drama scene that is, and that's just causing a lot of uncertainty. And when we see uncertainty in the market, people park their money in the safer bond market. Tariffs is probably the big thing. So the Mexico and the Canada tariffs are taking effect tomorrow and Tuesday, and there's a lot of squawk out there in media that says, hey, everybody's prices are going to go up. But there's a counter argument to that we're probably going to see it not impact our prices as much, because we're starting to see some shift in some companies and what they're doing. And time will tell. Obviously, we'll see if these tariffs have an impact. Obviously, if prices go up, that is weaker for the pocketbook. And that's not going to be good for everybody. How will it affect rates? It just depends how the bond traders really react to this. If it looks like it's not going to impact the economy as much, that's actually a strength of the economy long term. The next thing is jobs. So the first week in every month is jobs week. We get wage information coming out, unemployment, jobless claims, how many jobs are added, how many jobs are taken away. So just about every single day this week is jobs numbers. And if we see generally a weaker jobs numbers, that's a weaker economy. That means good for mortgage rates. If we see strong job numbers above expectations, we'll see rates go up. If we see wages go up, that's inflationary. That could weaken the interest rates, and they could go down. So we'll just be watching those job numbers every day. And then the last thing, a lot of Fed members are speaking this week. So every time they talk, the meeting's coming up in a few weeks. Every time they talk, it does impact the market. So that's about it. A lot of data, a lot of stuff coming out. Could be a lot of volatility. We're really floating right now, moving into a locking position if we see any shift. So have a great productive week. Look for my rate drop on Friday, and we'll talk to you soon. Bye-bye.